I think it's important to discuss what is happening in China and why, we've been saying for those that have been following us, it's no surprise that we never believed the 5.5% GDP growth. But now even the CCP doesn't believe it, and they're looking at ways to address it. And we want to touch on that in a minute. So the 1-year term lending facility is the same, 2.85%. We don't see much happening on the PBOC front just because they've been very clear of, look, we can't do much given that we've done so much already. Law of diminishing returns. What size are we going to really be able to do? New home prices still fell negative 10 basis points. So again, you're still seeing home prices coming down. GDP quarter on quarter was expected to be at negative 2%, came in at negative 2.6%. GDP year on year was expected at 1.2%, came in at 0.4%. So again, you're seeing that pressure to the downside. And just think, this is what China is openly saying. So what is the actual number looking like? Because if you listen to what we've been saying that it's not actually a positive 5.5%, it's actually a negative 5%. So it's just the pressure that we're seeing. Industrial production coming in below estimates. Retail sales, what did better than expected, was expected to be at 0.3, came in at positive 3.1. But we want to uncover that just a bit as we go through it. And then when you look at the fixed assets, property investment was expected to be at negative 4.2%, came in at negative 5.4. Residential property sales, negative 31.8. Jobless rate got a bit better, but we want to look at where did it get better, because it's still not helping the younger component of the populace. With the prime rates staying flat, again, PBOC not doing all that much, with the industrial profits pretty much holding steady with where they were in 2021. But the Politburo is meeting, and they meet once a month, and I think it's important to understand why is that so important. Because at the meeting, there's a likelihood that the officials will walk back the 2022 GDP target of around 5.5%. And the reason why they're going to do that is because they don't want to do excess stimulus. And the PBOC, I think, is doing the right thing by saying, look, we can't help you. And we'll do what we can, but we can't do much more without creating a big problem on an inflation front. There's already concern about onshore and clearly offshore debt, but they're hamstrung, and I think that's starting to sink in and shifting some of the policies that the CCP is looking to roll out. So but again, not that anyone believed it at this point, but the IMF did, the other people that are looking at global growth did, and that, as you see what the U.S. printed, what we think Europe's going to print. Now, when you look at what China's printed, all of them are negative, and they're over 50% of global GDP. So how can global GDP be growing when your largest growth engines are now firmly negative? So it's unclear just exactly how the walkback will be worded, because, again, it's a very important vote coming up in November, and how would they want to present this? And then at the minimum, officials will blame something on the order of complex and unforeseen external factors, obviously blaming COVID, lockdowns. But you can't blame lockdowns too much, because that is a CCP directive. So again, there's going to have to be a balance in the message. And whether or not officials explicitly tie their revised growth aims to the COVID containment policy, which again is the key. Xi gave a nod in that direction on his recent inspection tour of Wuhan, indicating that people's health and safety is a higher priority than economic growth. Clients may wonder why we continue to focus on so obsessively on this, and again, it's important because how this is indicated and what kind of stimulus is there, and it's just they can't do stimulus. So additional economic support is there, but what kind of special purpose bonds, what kind of bank lending can be done, because it's still not going to be enough. And we're already seeing that, where they've announced a new round of support for developers, but it's still not getting to where things really need to be. This could represent a substantial support on the order of up to 2.5% as you start to discount this back. But backing off the GDP growth target altogether has been a key focal point. The worst thing policymakers could do is panic and overstimulate and get overly aggressive. And again, that's what they're trying to avoid. And I think the PBOC has been very strategic and making sure they understand that and trying to adjust policy so they don't make additional blunders. High-level policy advisors have argued against overstimulation in recent weeks, that not only underscoring that the GDP growth target is now unattainable, but also advocating for caution to keep from overheating the economy. Besides some expect language around the growth target, we're not looking at significant economic policy. So again, nothing new coming about, but they may call for boosting infrastructure investment, which again, we've continued to highlight time and time again how that would be a poor use of capital given how overstimulated things are on the infrastructure side. Senior policy advisors are already outlining the need for additional fiscal measures to avoid a fiscal cliff in Q4. Because if you think about the fiscal stimulus that they've been doing, they've been trying to offset monetary, because PBOC said, look, we can't do anything to really help. The fiscal stepped in, and that is going to create more problems because, again, special purpose bonds continue to be the quota side. So do they bring forward more of that quota, or do they issue? And again, by bringing it forward into Q4, that means you're taking it from 2023, which I would be I think a bigger problem, but then lead to even more slowdown in 2023, which is why I think things are going to have to be adjusted on the growth front. And then, so the reason it's so important is that and that's why it's so important, because if they adjust fiscal policy so much, this is going to have a real impact on 2023 as well as 2022. And again, the reverberating factor, because they're just over-levering again local communities, local governments that already struggle to maintain the current quotas. So so not only are officials backing off on the growth target and underscoring the need to avoid overstimulating, but we have ongoing concerns about the efficacy of the coming infrastructure stimulus. So you're even starting to see people balk at what is the point of the infrastructure stimulus. And the spat of economic headwinds that could undermine growth in the second half of the year is dire with weak loan demand. And that's what we've been talking about. Loan demand has been weak. It's not that the supply isn't there, the demand isn't there. So you're just going to throw more supply when the demand is the problem, because people and companies are concerned. And so that's where we continue to see the economic, on the global economic front, scenario would clearly be a drag on output, but it may also translate into a more concerted disinflationary impulse from China, giving developed world central banks a little more breathing room than is currently expected. If you start to see them start to adjust their growth rate between that 2% and 4%. So the reasons why it's so important, when you look at just the sales manager side, it's still negative, kind of flatlining. Business confidence, again, flat. Market growth expectations recovering, still negative. But then when you look at sales growth coming further down, prices charged elevated, but still not, and coming down a bit. Staffing levels improving slightly, but where is it improving is important. Because when you look at China consumer confidence, it's the lowest it's ever been, going back to 1996. So how are people going to feel better and go spend when clearly consumers have the least amount of confidence ever, because of so much of their money, so much of their savings is tied up in real estate, in housing, and that is, I think, a bigger problem. So young people in China are bearing the brunt of the weak labor market, because workers aged 16 to 24 continue to struggle to find work. All workers have gotten better, but as we said, that key attribute is not there, and that's going to lead to additional problems. But what about the discontent? And this is why they're focusing so much on the labor front, because the real estate issues triggered about 1/5 of protests in recent years, but so is labor. So when you think about unemployment and real estate, if you can't find employment, you can't spend. And if your wealth is tied up in real estate and it's coming down, well, again, coming back to the weak consumer. So foreign companies in China have had a roller coaster 2 years with record profit growth in 2021, followed by record declines this year. And that's what we've been talking about, the problems that remain, where everyone was very excited about 21. A lot of it was artificially inflated, given all of the stimulus back to the point of the fiscal cliff. And now you're getting these huge lasting effects. And speaking of the lasting effects, it's what is the working age population, and you can see it flatlining and falling. And this is the problem that we've been talking about when looking at the underlying economic growth. What is going to be the productivity of employees, but also housing, because when you have a declining population, housing becomes oversaturated, which it already is in China when you think about ghost cities and other. So that's why when we talk about the fiscal plan, so right now Beijing plans to launch a relief fund for developers that could be as large as 300 billion renminbi, but it's still not enough. We've gotten estimates that are as high as tens of billions of dollars that would be needed. Hundreds of billions of dollars that could be needed, upwards to 1.5 trillion. So to come in with 300 billion is a drop in a bucket to what actually needs to be done. So China Construction Bank will contribute 50 billion renminbi. The rest will come from the central bank re-lending facility. And that's the other thing of how much will come through, because the PBOC is nervous about getting too involved in this. And the aim would be to acquire and finish buildings, because there is a significant amount of building projects that have just been abandoned. Upon completion, the homes will be rented out. But how much are the homes demanded? And if you have the population side coming down, becoming a bigger issue, you have this overbuild because of infrastructure, because of real estate. Remember, this was the mantra over the last 20 years was infrastructure, real estate, and now you're starting to see this oversaturation in the market. So REDD, a financial news outlet, said that the funds will also be used to buy financial products issued by developers and to finance the acquisition. Red reported that the fund will support a dozen developers, including Evergrande. The others will be chosen by local governments and regulators. Since the end of 2021, regulators have been wary of reflating housing prices. Consequently, their efforts to ease pressure on developers have been moderate and incremental. But the approach has clearly failed, but there's concern about inflation because home prices were so high in China that they wanted to try to do this balancing act, which has been an underlying problem. So when you look at industrial profits, so yes, things look good for the most part, but they're all driven by SOEs, with the private side not benefiting. And the private small entities are a huge employer within China, and they're not getting what they need. So when you look at some of the components from Premier Li, highlight consumer-friendly support measures. Despite post-lockdown rebound of industrial activity in June, consumption remains in the dumps. So even though we got retail sales bouncing, a lot of that was a makeup. And now based on what the go forward data, things are weakening again. So Li is looking to financial institutions to provide flexible loan arrangements for individuals, supporting stable and healthy development. And then again, I just don't see this working too much because you have a chicken and the egg scenario. How can policymakers jolt these two sectors, being public confidence for home purchases and increasing disposable income, from the current malaise, if you will, or slowdown, without reviving consumer demand? Then there's no demand, and that's the biggest problem. That was what they tried to address with common prosperity. That was what they tried to address with dual circulation strategy. They're just not getting that turnover that they need. So since April, policymakers have indicated that they will look to adjust their heavy-handed approach to the property and tech sectors to relieve some pressure, which is good, but how much is too much? Beijing largely relies on local governments to administer localized property policy, so there is less control here. But again, the issues remain as new home prices continue to move negative. They were down negative 1.3% in June. Delivery delays. Many Chinese cities are seeing delays in completion of new homes, with some of them outright abandoned, and that's becoming an issue because now people have not only life savings locked up in terms of, not in terms of down payments, but also life savings because they were financing things. Because the developer said, not only will you get this apartment, but you'll also share in the upside on collecting rent if you buy this MVP product. And that's, again, they're locked in on multiple levels. So the outlook for Chinese exports is getting worse, and especially when you look at just what has happened in Europe, and what has happened in the U.S. So as U.S. manufacturing survey, average Fed districts have gone negative. The Euro area economic expectations have gone negative. Exports to the U.S. from China and into the U.S. and the EU are going to follow suit. As you can see, they are fairly closely aligned in terms of direction, making things much worse. But when you consider just the size, and I want to stress just the scale of this when we're talking about how can they achieve GDP growth, 225 million square meters of unfinished homes. So think about that number and just how big that is. So who are you going to put there? How are you going to finance this? And how much of it just needs to go away? And I think that's the underlying problem that we're facing at this point. So the face-off between Chinese property developers and disgruntled homeowners may continue, with Sunak probably under the most pressure, as it has 60 million square meters of homes it must complete in 2022 to 2025. Evergrande is next with 53 million, followed by Greenland at 26 million, with 8 other distressed or defaulted developers, bringing the total number. So how is the government going to backstop this? And that's when you start looking at, which is why we said 200, 300 billion renminbi is a drop in the bucket of what is going to be needed to finish these, because many of them have been abandoned, leaving a lot of the consumers behind. So the Chinese consumer confidence is at an all-time low because of that. Again, you can't, with the confidence this low, how are you going to get consumption? How are you going to spur some of this? You have exports coming down, which saved you in 2021, and that can't save you this year. How are you going to spin this positive? With the plumbing depths, China high-yield dollar bonds are back near March's record lows, but you got a little bit of a bounce when they announced the support, but not a whole lot. Again, leading to what we've been talking about. China building halts may impact $700 billion in properties. So $700 billion US dollars are going to be hit. So that's 4.7 trillion yuan, and you're going to support 300 billion renminbi. Again, like, this is what we're talking about. Even the base scenario of 2.4 trillion, and you're going to support it with 300 billion. This is the sheer size that we're talking about. So construction halts may affect $700 billion worth of homes. The percentage of pre-sold residency that have been stalled could rise to 8% from the current 4%, according to the downside scenario. So we're looking at the underlying pressure. How is this going to snap back given the small level of data? Developer bond repayment issues are not getting better. They're only getting worse. As of July 8th, we have defaults continuing to expand, and the numbers of cities with year-on-year declines in new home prices are continuing to rise. So then when you look at loan demand is falling despite easy policy settings. So this is what we've been talking about. They keep saying they're going to increase supply. Increase to who? Nobody wants them. So again, you're just increasing supply into a market that is already oversupplied. The mortgage revolt, just giving an idea of where this is. So where unfinished property projects have sparked boycotts on paying loans. Chinese home buyers usually pool the whole family's resources to buy a home. It is a life and death matter for them if their home has become negative assets. And that's why there is such a focus on this. Bank estimates of at-risk mortgages, you get an idea of just how big it is, which when you look at the fact that we're already over into the trillions of yuan, I think it's, again, important to appreciate why that 300 to 400 billion renminbi is just a drop in the bucket. Developers are suspending construction as financing problems worsen. And again, that just means that pool is going to have to get bigger. Chinese property developers are halting work on a growing number of home construction projects, as indicated by the gap between growth and the pipeline of new projects and current construction, now at its widest in over a decade. And that's when you look at the Hang Seng Property Index, small bounce, but China will launch a real estate fund, 300 billion yuan, or $44 billion. So they're throwing 44 billion US dollars at a minimum of an $800 billion problem. So just give you an idea on the scale and scope of what we're discussing. The credit impulse remains inconclusive in the face of soft demand. So again, they're trying to protect credit impulses, but they're just not getting that kind of growth. It's stopped things from going down in terms of the impulse, but they also don't want to overstimulate, and that's that walk that they're trying to do. And you can see just the credit and fiscal impulse is really starting to flatline, and we actually don't even see it getting to 7%, just given the lack of demand in the market and the hesitancy of the PBOC. So now when we turn to India, India things have remained fairly stable. Wholesale prices were expected at 15.63%, came in at 15.18%. Still high, still a problem, but not getting much worse. But as we've been saying, we don't expect it to get much worse. Just continue to kind of fester at these levels. Exports came in at 23.5, imports 57.6. But things are getting a little bit slower. So when you look at sales manager index, it's now negative. Business confidence has gone negative. Market growth remains negative in terms of the survey. Sales growth has now fallen. Prices charged, again, staying elevated. Staffing levels improved, still on the contraction side, as profit margins still struggle. So again, still a lot of problems that we're seeing just beneath the surface on the Indian economy side. While on the Japanese side, CPI was expected to be 0.9, came in at 1%, so things are getting worse. Manufacturing output, again, negative, so we're now back into negative growth. That's on the manufacturing front and the composite, so Japan is back into contraction. Service business, slightly positive, but getting worse, but PPI, still staying elevated, which is, again, that leading indicator for where CPI is going. And remember, the U.S. imports this inflationary pressure. South Korea manufacturing survey continuing to worsen. Non-manufacturing survey still flattish, but getting there. Again, we still think that there's problems that remain in the region. Exports did have a nice bounce. Still not to the highs of 2022, but still strong for this period. So a little bit of a support when you're looking at global trade, with Taiwan continuing to show something similar. And then South Korea consumer confidence falling, dropping like a rock, which is a problem for internal consumption. So while exports remaining okay, we still see a lot of problems in South Korea, especially on the consumer side. Now, there's been a lot of uncertainty in terms of China, U.S., Taiwan. Speaker of the House Pelosi was supposed to go to Taiwan. There's been a lot of back and forth. President Biden has come out and reiterated our support for a one China policy, but again, there's still a lot of issues, and there's been a certain amount of Chinese jets that have scrambled into Taiwanese airspace, and that's something to watch closely as things. But again, as we talked about, China has a lot of issues economically. They need the U.S., so it's unlikely they're going to get too aggressive, even if the visit goes through as expected. So that's what we have for you today. If you have any questions, feel free to find us in the comment section or on Twitter, and we hope you have enjoy the rest of your week. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.